Hi, I'm Shakti Priyan. As part of my YouTube channel, I'm sharing my journey of building wealth. As part of this video, we will look at what is asset allocation and what is rebalancing and how I am doing my asset allocation and how I am managing the rebalancing part of it. Passing for the disclaimer, let's continue. As part of this video, we will look at these five things. One, what is asset allocation? What is my asset allocation? What is rebalancing? And how do I manage my rebalancing? And summary of the contents. Asset allocation is essentially how you go and divide your portfolio across multiple asset types like equity, debt, and gold based on the time horizon you are looking at and the risk comfort, right? So it is essentially the portfolio recipe, the mix which you are putting into the asset allocation, right, will determine the risk level of your portfolio, its return potential, volatility of the portfolio, and how smoothly it compounds, right? So essentially, by choosing various asset allocations based on the time horizon you are looking at, longer the time horizon, more equity you can go on. So as I was maturing my investment journey, I started putting out asset allocation, right, at some point in time. And I use this asset allocation for a couple of years. So this is where how I devised it, right? So essentially, it contains multiple components. I broke them down into four different groups. One is for US equity, which is Nasdaq 100 index fund, and other is the Sensex fund. And the other two offs, one was into non-equity, which is debt and gold. Debt was 15% and gold was at 10%. And remaining 25%, I went and like planned investment into a actively managed funds. At that point in time, IT was doing well, so I just picked up IT at the time, and then I pick up another 15% for multi-cap fund. This is my next plan in the evaluation, right? So here 5% of debt went down from 15% to 10%, and the 5% I added up in the US equity. So if you take Indian equity, the multi-cap fund and IT fund, I moved to more like a mid-cap fund and a small-cap fund here. But still here, this 20% is still active funds. Sensex and Nasdaq are index funds, which is at 60%, and remaining in gold and debt. So this is my next step in evolving the asset allocation. So the gold and debt fund staying the same. The Nasdaq went up 5%. I'm more and more convinced of doing more and more Nasdaq because again of its long growth potential and how it was growing, right? So there is like a couple of videos I've done related to Nasdaq. You can take a look at them. So if we talk about Indian equity, I moved away from active funds, completely made up of index funds, right? Four index funds I have chosen, which is Nifty 50, Next 50, Mid Cap 150, and Small Cap 250. And so this portfolio, which is the current one which I am running through, is like entirely made of index fund, right? So 80% of the portfolio is index fund, remaining 20%, 10% in gold and 10% in debt. So as the year is progressing, I started looking at what I will do in next year, right? So I started building it out. So this is where I stand at this today. So if you look at this one, here I moved out small cap. Out of the 5% I was allocating there, it is moved into US equity. Now, if you see this particular allocation, it's more symmetrical, right? So 80% into equity, 20% in non-equity. So non-equity 20% is going into 10% gold and 10% debt, and 80% equity I'm putting 40% into India and 40% into US. And within 40% India, there is a 20% core portfolio, which is Nifty 50, which is off of that 40%, right? The remaining off is again further split into mid cap 150 for 10% and another next 50 for 10%, right? So essentially, like the asset allocation is evolving. I hope this will stay longer. So let's look at why such a allocation, right? So based on my time horizon and the comfort level, I'm picking up 80% long-term equity there. And so this is again diversified across multiple things, diversified across classes, right? There's a equity, debt, and gold diversified across geography and currency by being Nasdaq 100 ETF, right? And then within India, even by market capitalization, we are diversifying across like three market caps, right? Nifty, Next 50, and mid cap. And so equity exposure is via only index fund, right? So there is no active fund involved, and index funds keep costs low. So 20% non-equity, one, it can act as a drawdown protection in the portfolio, and two, it acts as a dry powder when situation arise, right? So drawdown protection means when market goes down, how much it can go down in your portfolio, right? The non-equity component can also be used to go and buy the equity components when they are at a lower value, right? So there are six target buckets to manage and rebalance part of this portfolio. And it is simple to maintain. It's not so all of them are index fund. Let's talk about rebalancing, right? So rebalancing is essentially adjusting your portfolio periodically to maintain your target asset allocation, right? So we say let's say 20% for Nifty 50. So it needs to be around 20%, right? So it cannot go to 30% or it cannot go down to 10%, right? That's what rebalancing means. So any asset allocation, rebalancing is part of it, right? So you have to rebalance your asset to maintain your allocation, right? So why rebalancing is required, right? So rebalancing will prevent overweight in high performing assets and maintain a desired risk profile, right? So the ratio at which you are setting up the asset allocation will have its own risk profile. If you're deviating from that, the risk profile of the portfolio will change. So let's look at when to do rebalancing, right? So rebalancing can be done either a time based or threshold based. So in case of time based, you can do it annually or off yearly and so on, right? And if it's a threshold based, you can say, okay, if this particular asset class goes beyond this particular percentage, I will go and buy that more or sell that off, right? So how do we do the rebalancing, right? Essentially, we sell overweight assets and buy underweight assets, right? So this is what the rebalancing, if you search over, this is what you will find. But that's not how I am doing it, right? So I will explain what I am doing it in the next slide. Important to know that rebalancing will have an impact on taxation. So you have to which will have an impact on the overall the portfolio growth, right? If you cut like if you pay tax out of the portfolio because you are moving over from one asset class to another, so that will have an impact on the overall portfolio's growth as well. So let's look at how I manage rebalancing, right? So I use a monthly cash flow based system where based on the cash flow and threshold I'm setting up for each of the asset classes, I'm doing a rebalancing, right? So what does it mean? So if you see, if an asset is above its target, I stop buying it. So let's say if gold I want to retain 10% and gold prices went high, right? So I stopped buying gold, right? I'm not adding like buying gold as part of my monthly investment. I just stopped buying gold there. And I invest my new money only into these underweight assets, the assets where they are below their threshold. And the split, how do I split this monthly investment, right? I split them proportional to how the underweight each asset is. So what does it mean, right? So this is how I allocate monthly investment. So I calculate the deviation for each asset class. Okay. So what is the target value and what is the current value? And exclude anything that is in negative, right? Meaning the current value is higher than the target value, right? So meaning that particular asset class is over its set target value, right? So allocate new money based on the deviations of the ratios, and this fixes the imbalance without selling any asset. So this is how. So to give you an example here, right? So let's assume that there's a portfolio which is 5 lakhs now, and monthly inflow we are adding in 20,000 into it. So if you see here, there are four different asset classes I have taken it here: Nifty 50, Nasdaq 100, debt and gold, each at 40, 40, 10, and 10 respectively. That's a target allocation, right? So based on the current portfolio value, my current allocation, if you see there, Nifty 50 is only 39 instead of 40, and Nasdaq is 39.9 instead of 40, and debt and gold are slightly over, debt at 10.5 and gold at 10.6 rather than just a target value of 10, right? So if you compute the current value, so those are the numbers that are put in, right? Those are the current market value of that particular asset classes, and adding them up, it comes to 5 lakhs, right? So Nifty 50 is at 1 lakh 95,000, and so when I calculate the target, I also include the monthly inflow. So I add 20,000 to the 5 lakh corpus that already exists. So now the target is 5 lakhs 20,000. So yeah, proportionately for the given percentages we apply on top of the 5,20,000, we get these numbers. So the target for Nifty 50 is 2,08,000, and similarly for Nasdaq 100, both at 40%, right? And debt and gold at 52,000. So this yields that overall value of 5,20,000 after we invest that money, right? So how do we now go about investing it, right? No, so I know the current value and what should be the target value, right? So now what I do is I go and take the diff wherever the asset classes that are over the target value, I don't include them into buying. So in this case, I'm debt and gold. I'm not computing the diff and adjusted, right? The diff here is in negative, and I'm not going to buy them. So I'm keeping them blank here. So Nifty 50 and Nasdaq 100, based on their target and current value, the diff was identified, which is 13,000 for Nifty 50 and 8,500 for Nasdaq 100. Then which comes to 21,500, right? So because the other ones are having negative, so 21,500 is required. So we have to adjust them. We have to scale them down, right? So in this case, you take the same ratio, 13,000 is to 8,500. Convert them to match this 20,000 profile. Then it scales down to 12,000 and 8,000, right? So this is how I identify how much I have to buy in a particular asset class every month, and then I go and execute these purchases, right? So if you look at this, compare this against to a static SIP, right? Where if you just went and said, okay, we will just do a plain old SIP setup, where we will do it for a year or something, you'll go and set up the SIP, done with it, right? So in this SIP model, where the static column is said, right, which is following the 40%, 40%, 10 and 10% allocation for the 20,000. And we will always keep buying this 8,000, 8,000, 2,000, 2,000, irrespective of the market condition, right? In the current example, the debt and gold are higher than the target allocation. Still, we would have bought 2,000, 2,000 in the static mechanism like SIP, right? So I don't do the SIPs. So I go and do this dynamic calculation, identify what is the current market situation based on my funds, what I have. I don't even look at anything at the market, right? I just look at my target values in my portfolio and dynamically decide what needs to be bought, so that it brings them towards their like target value, right? So here in dynamic allocation, what I explained earlier, now I will just go and buy for 12,000 at Nifty 50, Nasdaq 100 8,000, right? I don't buy debt and gold, which are already higher than my target, right? Why do I want to buy them higher? And if Nifty 50 and Nasdaq 100 are lower because either they slow down, or right, there is some drop in the performance. So they are lower than their whatever their set allocation, right? So essentially we buy more of things that are cheaper, and right, and that also in the ratio at which they are, right? So in this case, Nifty 50 and Nasdaq 100, Nifty 50 was at 39.0, and Nasdaq was 39.9, and we are buying the Nasdaq 100 lesser than the Nifty 50 what we are buying, right? So the 8,000 we are buying for Nasdaq 100 and 12,000 we are buying for Nifty 50. So this is how we dynamically go and do a monthly purchase. So this itself will do the rebalancing. We don't need any special rebalancing activity, right? So this is how right. So there is no selling involved here. There is no zero tax, right? So there is since you are not selling any asset, we are just rebalancing the way in which we are purchasing. The tax is nil. And so it automatically maintains the target allocation, because that is what we are achieving with every purchase, right? We go and buy things which are lesser than their target allocation, and we try to nudge them towards the target allocation, right? And it's emotion free and rules based, right? So there is no I don't have to worry whether something goes up or down. I just go and apply this formula, get them out. I know what exactly has to be bought for each of the asset classes, and this essentially buys at low, avoids buying anything at a higher price. For example, gold, right? Past probably even this entire financial year, right? Gold started picking up. It's much higher than my allocated value of 10% for the gold. So I stopped buying gold for like for a long time now, right? Which may be counterintuitive, right? So this is essentially mean reversion here. So when the values it stops at some point, and it will comes down to 10%. If it goes below that, then I start buying gold. That's how these whole asset allocation and rebalancing work for me. And this is again best suited for accumulation stage, where we are accumulating money, building the corpus when you are working actively into it, right? So to summarize the whole thing, right? So this is how I'm looking at it, right? So the asset allocation and rebalancing part of it. So I have 80% into equity and 20% into non-equity, and it is diversified across India, US, debt, and gold. And I'm primarily using this cash flow based rebalancing based on the deviation ratios that I am deriving from them. And there is zero selling and unless absolutely necessary, right? And this is very clean, mathematically precise, and tax efficient strategy. Thank you for watching my video. If you like this video, you can look at these other videos which I have made so far. See you in the next video.